As we all know, one of the most important things aside from credit is income calculation, right? And here at Equity Smart Home Loans, we want to make sure that we teach you guys how to calculate income properly. So I'm going to be dissecting down different income areas and give you some tips that you might not even be aware of. A lot of loan officers are not aware of when it comes to calculating rental income on a Schedule E. So without further ado, let's go ahead and get started. So in this presentation, we're going to be covering two things. Very simple: how to calculate Schedule E income. The Schedule E means rent or income from the properties that a borrower may own, right? And some Schedule E's may be, some borrowers may have multiple properties. So you may have two, three, or four sheets of Schedule E's, and you got to painstakingly, unfortunately, go through each one so you can derive at the actual income. And but hopefully I made it super easy for you guys. The last thing I'm going to be covering is the income, which is very simple on when they don't have a Schedule E and they are purchasing a property or they're leaving a property. How do you calculate that income, right? So in other words, if you currently are buying a rental property, haven't owned it yet, what can you use in terms of rental income? Or if you're leaving your primary residence and you're going to rent your current property, then we're going to show you how to calculate that as well. I'd kindly ask everyone to please mute your mics if you haven't done so already, just so that we don't get any background interference and we can get through this very smoothly. I will go ahead and open it up for questions. In fact, you know what? Go ahead and let me see if I can open up the chat, and I will be monitoring for any questions that you guys may have, or feel free to unmute yourself and ask any questions you may have. So, all right, calculating income. So let's go to the next slide here. How to easily calculate rental income tax form 1040. So this is going to be specific to personal tax returns. This is not business tax returns or anything like this. This is someone that reports their property on a Schedule E on a 1040 document. So it'll be specific to that. And it's very simple, actually. Anything to do with PITI, principal, interest, taxes, insurance, must be backed out or ignored, essentially. And I'm going to go through some examples so you guys can clearly understand that. So, but this is the main thing you have to know on the Schedule E. We're going to ignore anything that has to do with PITI. Next thing we're going to ignore is depreciation. And we want to do that as well because we don't want to lower the income that we can give the borrower. The last one is repair items. People are going to have repair items on their taxes. Now, most of the time you're going to ignore it. This is one of those areas where it can go either way. So I've highlighted this in the other screen. You'll see it. But this is something a lot of loan officers are not aware of. When it comes to repairs, most loan officers will just back out or deduct the whole thing. But if you have a borrower that's well organized and has good documentation, then you're going to be able to back out anything that has to do with one-time repairs. And what is a one-time repair? One-time repair consists of anything that's going to be fixed not on a continuous basis, like maintenance, gardening, things of that. There's a pool, things that are routine, right? One-time expenses are going to be like a roof, right? You only fix a roof once every 15, 20 years. Windows, right? You don't change the windows every year. You change those once every 15, 20, 30 years, whatever it may be. So those things you're going to be able to put back in there and or back those things out, so that way they don't get hit on their income with those things. But it has to be a one-time repair, or something that is a one-time repair, just like the things that I mentioned. And just as important, you have to be able to document it. Now, one of the things that investors that own properties or multiple properties in this section, this area, the repair area, it's open to writing off a lot of stuff. And so bars may write off a lot of stuff that really wasn't done to the property. And they do this because it's easy to get away with. Sometimes the IRS doesn't check this. and people just tend to throw extra stuff in there. And most of the time, in my experience, people don't have the documentation to prove to you that they did some repairs, right? Um, there's going to be a lot of instances where the bar did is going to have the receipts and they did actual one-time repairs. And that's a good thing about one-time repairs. They're very expensive, and most of the time they're going to have documentation for those things that they bought because they want to write them off, right? So if they are one-time expenses, that you should see some kind of documentation for that stuff, and you're going to need it. You can't just say, hey, these were just one-time repair items. So let's get right into it. um, right here, what I'm giving you an example of is a schedule E. And on the schedule E, let me see if I can create a marker here so I can highlight things. Yeah, I'm not too sure how to do it on Zoom. I'm pretty good with Google Meet and I know how to do it there. So I'll just put my mouse cursor. Hopefully you guys can see that. But this is going to be the Schedule E, and anyone that owns rental property is going to have this on their tax returns, right? So if the bar, you're taking the application and the bar says, oh yeah, I own, 3 or 4 properties, then you should find this on the tax returns. It's going to say Schedule E. This is a sample that I took for 2020. And the properties are going to be right here. They're going to be listed. They could list up to 3 properties. So you're going to have property A, B, and C. And then here in the bottom, you're going to see a type of property, right? So usually they'll put the type of units, right? If it's a 2-unit, 1-unit. Sometimes they don't even put the right type of property on here. Also, how many days was it rented for the year? Sometimes this could be important because and I want you to pay attention to this and make a mental note. I didn't write this anywhere down here, but if a owner just bought a property, let's say halfway through the year, then in most cases, what I've experienced myself personally when I'm doing home loans is the CPA will still leave it at 365 days. And if they only collected rent for 6 months, that could cause you problems because the underwriter is going to look at this and say, okay, for property A, and by the way, the properties are itemized here, as you can see. Property A, oops, let me see if I can go back or forward, actually. Okay, so you have property A, you have property B, and property C. And for this example that I've put in together for you guys, we're going to go through property C. So we can go down here, the items, and figure out how we're going to calculate the income. So again, this is going to be important to look at if the bar told you, well, I've only owned the property 3 months last year, the previous year, so it's not going to reflect the whole uh, 12 months, right? And like I said, in most cases that I've experienced, the CPAs or the tax preparers are going to put the wrong fair rental days. They just by default leave 360 days, and you may need to get an explanation letter if you're trying to just calculate 3 months worth of rent so that you can use a higher rent amount, if that makes any sense. uh, I know there's a question that says, can AC can be used? So I'm thinking maybe the air conditioning for a one-time expense. That's what it sounds like you're asking. And yes, a whole AC system is not something that you buy every year, right? A AC system is something that you're gonna probably buy maybe 5, 10, 15 years, depending on the system. And so it could be considered a one-time expense. Again, anything that's not routine, it can be considered a one-time expense because it's attached to the real estate and it's not going to need to be changed often. So that's probably the question you want to ask: is the bar going to need to change this in the next 12 months? Most likely not, the AC system. So then it should qualify for a one-time expense. When we get to the repair items here, I'll talk about it more. So again, just to recap, because I want you guys to really understand, Schedule E is going to be a worksheet on the 1040s. You know it's a 1040 because down here in the bottom, you can see it says Schedule E 1040, Form 1040. You can always look at the bottom here, or here at the top, it says 1040. And these sheets come with 3 properties, right? So it's going to have property A, B, C. And I actually deleted these because these are actual Schedule E for someone. So I didn't want anyone to have the private information. So then we're gonna look at the type of properties, and sometimes this is wrong too, right? Uh, and it'll tell you right here on the type of property. I'm sorry, I had said earlier the two unit, 1 unit, two, but it's actually, if you look at the type of property here, it gives you a little uh, item. It tells you what the number means, right? So number one means a single family residence, and then number two means multi-family residence. Sometimes people put their Airbnbs on here. So if they do that, then it's going to come out here on vacation tour. And by the way, this is the correct way of doing it. Some tax preparers, they'll do the Airbnbs or the short-term rentals on a Schedule C instead of a Schedule E. But the correct way of doing it is to put it on the Schedule E. All right, so let's go through this example here. So like I mentioned before, anything that has to do with the PITI, and I've already put it in yellow for us just to make it simple, we're gonna not add into our calculation, right? So we're gonna ignore the insurance because that has to do with PITI. The mortgage interest paid to the banks also has to do with PITI. Uh, Number 16, the taxes also have to do with PITI. So we're going to ignore that as well, right? So when we're doing our calculations, we're not going to factor these in here because if we did, it's going to decrease the amount of income. And not only that, you're going to get hit twice because for you to understand why we're not calculating this as an expense on the Schedule E, very simple. When you go to your point of sale systems, Lending Pad or Blink, when you fill in the REO section in the liability, you're already going to put that payment in for that property. If there's an existing mortgage, you're already going to put it in there. So if you take the expenses here now on the Schedule E, then what you're doing in essence is hitting the customer twice. And not only that, but you're cheating yourself as well because you're not giving the customer the maximum amount of income that you can give them, right? So imagine you're already hitting them with the payment on on lending pad on your system. Then if you don't back these out, then you're going to be in essence be hitting them twice, and it's going to lower the amount of income. And so many loan officers make that mistake. They don't realize that that's what's happening. And this is one of the main reasons why I wanted to do this presentation so that I can make this very clear that in order to get more income for the bar, you need to back these things out. And just remember, anything to do with PITI on here, you need to just ignore it. If it's an HOA, same thing. You're going to ignore it because you're going to put that on the REO section of your loan application on your system. Okay, HOA fees or any other fees that they're being charged on a monthly basis, right? So let's go through this example, right? So we're going to start from the very top. So the customer, and for the year of 2020, received, and this property, because we're going to focus on one property for now. He received a total of 114,000 in gross income. Okay, so we're going to go down the items here, right? So he didn't write off for anything for advertising. He didn't write off anything for auto and travel, which you'll see oftentimes. Uh, Cleaning and maintenance, number 7, you can see here. He wrote off $9,192 in cleaning and maintenance, right? So then if you look here on the far right, we put section C. We're going to start with the rent that was received, right? So we're going to subtract line item 7, which is 9,192. The next item here is insurance. That has to do with PITI, so we're going to ignore it. $1,458 ignored. So as you can see here, I didn't include it in a deduction as we're deducting it from the gross rental income. The next item on here is the mortgage interest. The mortgage interest just has to do with PITI, so we're going to ignore it. You don't see it on here. The next thing we're going to see here is the repair items. Now, I put this in red because this is that one that's in the gray area. You always want to ask the bar, do you have one-time expenses that we can document? Then I could lower this, right? So imagine the bar wrote off 28,000 in repairs. And imagine 20,000 of that was for a new roof and only 8,000 was actually for repairs. How significantly would that change your income? That'd be huge, right? So that's why you got to ask this question. And you guys don't know how many deals I've won because a loan officer didn't ask that question, and the customer went with maybe two loan officers that told them that they didn't qualify because the DTI was too high. Well, this is an area where you can squeeze extra income out of by providing invoices and documentation supporting that there was a $20,000 roof. Now, for this example, I went ahead and just hit them with the whole 28,000, as you can see here, just so that we can derive what the actual income is. So we're going to assume that there was no one-time repairs. So we're going to hit them with the full 28,000. The next item on here is 13,112, and that's for property taxes. Property taxes have to do with PITI, so then we're going to ignore that. And you see up here, it's not part of my calculation. The next thing I'm going to do deduct is utilities. Utilities are recurring monthly operating cost, 8,032, as you can see right here. And then the last thing is that we have on here that you got to pay really close attention to is number 19. It's going to say others list. It's going to say statement number 3, right? So you can see statement number 3, we have 16,749. And I went ahead and I pulled up statement number 3 because you could find it towards the back of the tax return, so you can see what those costs are. And most of the time, those are going to be reoccurring costs or operating costs. Now, one thing that I put on blue on here that you don't add on here is depreciation. Depreciation is not a real cost. It's a deduction that property owners get for owning rental property, right? They're able to depreciate their property over 30 years, which allows them to pay less in taxes. This is why a lot of people enjoy owning rental properties. I myself have a ton of rental properties that I started buying a long time ago, and I get the benefits of the tax write-off. I can't even tell you how huge that is for you guys that are younger in your career and thinking about buying rental property. It's a great way to go. But the great news for qualifying purposes, this 15,442 that the person is writing off doesn't get hit over here, right? So the only thing we're going to have is we're going to start with the gross rents received, 114,000. We're going to deduct the cleaning, repairs, utilities, and others. And I'm going to show you others on the next screen so you guys can see that. And we're going to ignore, and if you just want to make it simple, and if you don't want to think of PITI, you can just ignore items 9, 12, and 16. They're always going to be the same unless they change the tax, they change the tax form, right? But this has been like this since I think I started in the business, and back in 1997. It hasn't really changed much. So get familiar with this, understand what you can deduct and what you shouldn't deduct. And very important on the repairs, and I can't emphasize this enough, don't call the processor saying, hey, you can ignore the rental income, the repair income, the repair items, because he had a one-time expense. You need to have the documentation. You're going to get asked for it. They're going to want to see invoices, checks, canceled checks, whatever, to prove that it was a one-time expense, a water heater, a AC system, a roof, windows, things of that nature. So I just can't emphasize that enough, because you want to take shortcuts, but you got to be really careful with this one because it can get you in trouble. All right. Total income calculator, right? So I did the math here for you guys. 114,000 minus 9,192 minus 28,544 minus 16,749 gives us a net amount of $51,483. So then we take the 51,483, we divide it by 12 months, and then the monthly income we can use for this property is going to be $4,290. So when you go to your REO screen on your application on LendingPad, you're going to plug this in as a rental income. And then what you're going to realize is that if they have a mortgage on there, it's going to go against that mortgage, and it's going to, so let's say that the mortgage is $3,000 a month, then the actual income is only really $1,290. But this is the amount you're going to plug into your system, and let the system do the rest of the math in backing out the mortgage, the actual mortgage. And again, the reason we don't hit them with the insurance, interest, and taxes is because they're going to get hit on it in the actual LOS system on your REO section. And So I have section 3 here. So I had to go back all the way back on the tax returns to find the form. And the way I found it, it actually says statement 3. So if you look on here on the actual tax form here on section 19, it says look at statement 3, right? So I go to statement 3, property C, and this is property C, and then I can see the additional expenses, right? So there was $9,292 for gardening, 446 for cable, 380 for alarm, licensing permit, and pool service. So the total expense was $16,749. These are all recurring costs, monthly operating costs for the property, so we cannot back anything out. Okay? Very simple. Any questions? All right, I'm going to go on to sample 2. It's the same thing. We're just going to do it one more time because I really want to ingrain it in your minds so that you don't forget this, and you could do this on your own, right? You're gonna have a borrower that has either a pay stub, salary, job. You're gonna be able to calculate that. They're gonna tell you, hey, I own 2-3 rental properties. Now you're gonna be able to calculate the income on the rental properties without having to wait for anyone, right? So in this example, we're gonna do the same thing. We're gonna go to section C, but this time the rental income is $71,087, and they didn't write anything off here on the top. We see the insurance, we're going to ignore that. The next thing we see is a mortgage interest, we're going to ignore that. So the next expense is only $17,752 in repairs. And again, do you have any one-time expenses? And you might not even want to ask a question like that, by the way. You might want to ask, like, what repairs did you do? Like, go down the list, because the bar may not understand what you mean by that, or what you're trying to get to, right? You're just going to say, hey, can you list all the repairs, and explain to them that you're going to be able to give them credit back if they're able to document some other repairs. Again, for this example, we're going to assume that there was no one-time repairs, so we're going to hit them with the full $17,752. The next item is taxes. We're going to ignore that because we already know that that's part of the PITI. The next item is utilities, which we've put on here as part of our calculation. You can see it on here. The next thing is the depreciation, but we already know depreciation is something that helps the landowner or the property owner just have additional deductions for their taxes. The other thing we're going to be careful for is section 19. There is a statement number 2 on there, 5312. So then we're going to take a look at that as well, and it's going to be in the back of the tax returns. So let's look at this again. We'll go down this again. We're going to ignore line items 9, 12, and 16. I should have probably put 18 in here because you're going to ignore that all the time. I'll make sure I put that next time. But those are the ones that you just always ignore. And again, if you see something that says HOA, like on a separate category or somewhere, HOA, monthly HOA, then you could ignore that as well, because that's going to be part of the PITI, like if they're renting a condo or something like that. All right, next thing, again, one-time repairs must be documented. And then we're going to go through the calculations, right? So from the very top, the gross income for 2020 was $71,087. And what that means is that that's the total gross income that the property owner received. And that can include rents and also maybe laundry income or any type of income. Maybe there's properties, I don't know if you guys ever seen properties that have billboards attached to them. They get income from that. Any type of income that property is going to derive, this is where it's going to reflect. Okay. So then the first item we're going to take out is the repairs. We're going to assume there's no one-time repairs, so we're going to hit them with the whole $17,752. The next item is the utilities. It's going to be $4,312. $15. Next item is going to be the statement number 2 items, which is going to be $53.12. So once we do our calculations, then the net income is $43,708. So then we simply take the $43,708, divide that by 12, equals $3,642 a month. You're going to go into your LOS system, REO section on this particular property, and then plug that in as your gross income. Okay. And then we're going to find section 2. So we went back on the tax returns and we can see section 2, right? And we can look at what the expenses are, right? So we have, again, we have, I think, gardening. We have amortization. And this one, actually, one of the properties that you see right here has HOA, but it's not our property, it's property B. So then that one, you wouldn't hit them with that, right? Because it has to do with PITI. Permits and licensing, 819, and then fire protection, 149. So that's how they came up with the 5312. And then you can confirm by going back to the actual tax return, or the worksheet, I should say. And you could look at sections 19, statement number 2, and these two figures should match, the 5312 and the 5312. And it's that simple. There is no other trick to this. You can, I always do it manually. It's the easiest way to go for me, just to make sure I don't miss anything. And sometimes I'll even do it twice just to double check my work. But you can get through these really quick. Like there's 3 properties on here, and you do the same. You go through the steps, each one of these one at a time, and then you can know exactly what the gross income. So now you don't have to be confused with property owners that may even have 20 properties, because you're going to be able to go through each one by one and figuring out what income you can use. So in most cases, most people own just maybe 1, 2, 3, or 4 properties. Rare when you come across someone that's going to have 15, 20 properties on their Schedule E, but they're out there and you are going to be able to run into them. Hope I made this super simple. The last thing I want to cover is rent. Since we're on the topic of rental income, I don't want you to confuse this with someone that doesn't own a property yet that plans to rent it out, right? So very simple formula for someone that's buying a rental property, right? You're going to take 75% of the gross income. So, for example, let's say that a customer wants to buy a property and rent it out as an investment, and he tells you, I'm going to rent it out for $5,000 a month. Then you're going to take 75% of that and make sure, which is $3,750, and make sure you plug that into your LOS system so that they're getting credit for that $3,750. And usually you're going to be able to do that on the subject property. And there's a section that says rental income, and you can plug that in there so that make sure you're giving them that credit. Okay. And you may have a combination. You may have an investor buying a property and you're going to give them that income. And then you're also going to go through their Schedule E's and give them that income. So I want to make sure you guys are using all the income. Now, for this situation, when they are buying a property and they're either departing residence, meaning that they're going to leave their house and leave it as a rental, you can only use 75% of the rent. If they're not moving and they're staying in their house and they're just buying a rental property, then you're only going to use 75% of the rent either way. So you're fine. Just remember that. Very important. You cannot just make numbers up out of thin air. You have to reach a number that makes sense for the market area, right? So if the market area could command $5,000 for a 3-bedroom, 2-bath house, then make sure that you're going to have comps and make sure that that sounds right, right? If you're in Beverly Hills, let's just as an example, you're going to be able to probably rent a 3-bedroom, 2-bath for maybe $10,000 a month, and it's going to be reasonable, right? So you have to understand what the going market rents are for those areas and not exaggerate too much, because when you order an appraisal, you're going to have to order a rental survey, and you cannot be way off of the rent, because then you're not going to get credit for the rent that you're thinking about, right? And this becomes very important when you are trying to qualify someone to purchase a property, that you reside more on the conservative side and don't get too aggressive with it, because you can get in trouble, right? So if the area could command 3,000, then maybe 33, 34, maybe 3,500 you'll get away with, but beyond that you're going to be pushing it, right? So know the area, understand the market area. Real estate agents, here at Clovis, we have access to our rent. We can look up on the NMLS and see what properties are renting for. You can go on Craigslist. You can go on any of these sites and see, plug in where there's rental properties being listed, and see what they're going for, what they're going rate, so that you're not too out of whack. You just want to be in line with what the area is commanding, so that you don't get any trouble. And again, these income calculations, I really want you guys to understand them, because they're going to keep you out of trouble when you're calculating a little bit more complex. I want to call this a little more complex bars, because they have a lot more going on with themselves, right? So imagine, this bar with rental income, and then he also has a Schedule C, and then he's self-employed and has a restaurant. It could get really complicated. So at least you got this piece out of the equation, and you understand exactly how to calculate the rental income. That's it for me on rental income. I would like to open it up for any Q&A. If something wasn't clear, I can reword it and state it a different way, or we can go through the example one more time if anyone would like.
Pablo, I have a couple of questions. This is Anahit.
Anahi, long time no see. Go ahead.
Yeah. Hi, Pablo. Okay, so my question is for the LLCs. Like some people can have like the rentals as LLC. And I remember one time we had in a training, and I think you mentioned that with LLC, we can just eliminate the rental, either it's like the income is positive or negative. It's my understanding. I just want to confirm with you that. So,
Yes, so that's a great question, and you know what I'll do? I'll do another training on LLC, because I want to break these down like by parts, because I think it makes it easier for everyone to understand. And then we're going to be able to take this video that we just did right now and put it in the training room, and this will specifically help someone with Schedule E. So when we get to the LLC and corporation stuff, I'll do videos on that as well, but I'll specifically focus on that, because it almost works the same way, right? They're gonna write off a bunch of stuff, and you're gonna back out the PITI the same way. It's just that they look a little different, the forms on the LLC, on the corporate documents and all that. But I promise you, I will get to that, and I will show you how that looks. But this is for Schedule E, personal returns for now, okay?
okay. The other question that I have is, imagine like I have encountered with those people, but I haven't done loan for them yet. But they have like a rental property, but they haven't rented out. For example, if they bought it last year and they haven't rented out yet, or they had it, they just didn't rent it. And now that they want to buy another property, they are thinking, oh, how can I use this one? Can I rent it right now and use the income? Like, because they don't have any Schedule E.
Yeah,
So
no,
how is there any way they can do that? Or
That's a really great question, and I didn't even think about bringing this up, and I'm so happy that you asked, because this is a very important question. So in essence, what Anaida is asking is, if someone owns a property and they haven't collected rent, so maybe they have their brother living rent free, or mother-in-law, or someone, right? And
yeah,
let's say they moved out or passed away, and now they're going to put it in the rental market, but they're trying to qualify for a loan. So because they didn't have it rented, you're not going to be able to use the rental income, unfortunately. You have to at least have 1 year of Schedule E if they've already owned the property. Now, where I have seen exceptions is where someone buys a property and it takes them 6 months, 8 months, and they can prove that the only reason that they didn't rent the property out was because it was under construction, repairs, or remodel. Then the lender is going to let you use a 75% of the gross income if you don't have a tax return in those instances. Now, if a family member moved out, or you just don't have it rented and you just haven't reported it, unfortunately, you're not going to be able to use that income, and there's no way of using it. It's just
okay,
they're not going to let you per Fannie or Freddie Mac guidelines. But that's a great question, because a lot of people may think it might default to this formula here that you're looking at right now on your screen, the 75%.
yeah,
Well, they just didn't rent it out. The mom moved out, and now they're going to rent it out. And no, because what they're looking for is, they want to make sure that you have what are the repairs going to look like? What are these things going to look like, right?
Pablo, this is
Yeah,
Leo. How are you?
I'm doing good. How are you?
Good. So the 75% applies just for rental income, for rental properties that they are buying, right? They are
Correct.
just buying. Okay.
Yeah,
So
for
you can
buying
apply.
or their departing residents.
Okay. Got
Yeah.
it. Thank you.
Yeah, but I really good really good question on that last part.
Okay. Thank you. Thank you for your response. Really appreciate it.
All right. Any other questions? All right, guys. I think with that said, I think you guys have a good understanding of what I explained. Hopefully you guys come across some bars so that you can get excited about doing these calculations and be like, wow, I actually did it and it worked. And the underwriter agrees with exactly my calculations, because that's the best feeling, right? When we submit a loan and the underwriter agrees with all of our calculations, because then now we know that we've reached another level of being able to structure our loans and put them together, and become that one step stronger and provide that better service for our LOs. And not only that, but give ourselves the confidence that we know we're doing our job correctly, and we're going to be able to close more deals by learning this stuff, right? Not be intimidated, like, oh my God, these tax returns, how do I figure all this out, right? Like I said before I end, if you have any suggestions on anything that you want me to do training on specifically, let us know. I can specifically detail these type of trainings and just emphasize and zero in on something on the part of the lending process to help you guys out get stronger in those areas. So I want to thank you guys so much. I look forward to seeing you next week, and thank you as always for participating and wanting to learn and grow. So that means a lot to me. Thank you
Thank
guys.
you,
Have a
Pablo.
good rest of your week. Productive. By the way, rates are really good, so make sure
Thank you.
you're looking at the rates. They're starting to come down somewhat, so there's going to be some refinance opportunities. So keep your eyes open. Have a good one.